like breakouts. They feel that they don't have enough information. They feel a little bit insecure about breakouts, and they love trading pullbacks. So I really cannot say that there's one strategy is better than the other. It really comes down to how do you feel as a trader. So what do you think? Do you see yourself as a breakout trader or as a pullback trader? Let me know in the video comments below. I would really like to see the majority of our traders, where do they fit into breakout or pullback. So really let me know in the comments below so that I can make maybe the next video about a specific approach where I see the most answers. And then here you can see what happens afterwards, the breakout, the retest with a nice pin bar, and then off we go. So breakouts, patterns are great, and the context is really important. Here we have, I called it the momentum death. So pretty dramatic, but I think it fits here the criteria. So on the left-hand side, you can see the market was in a strong downtrend. In a short period of time, the market moved lower quite a bit. And whenever you see that a market is changing its structure, this is where, as a trader, you should get very, very observant. You should start following the market, because when a market undergoes a change, then there are often great trading opportunities. So when the market goes from downtrend, very strong downtrend, to a market where on a long period there was no momentum, there was no continuation here of the downtrend, this is where you should really get interested in. Even more so when you see something like this here, where the market is already making higher lows. The market is suddenly really interested in trading here into the highs, whereas previously the market was more trading into the lows, which shows more selling interest. Now the market is trading into the highs, so that's a very, very big heads up here that you should have. And especially then when you have such a strong breakout signal. When you have a breakout with a very strong candle, that is really where you should pay attention. And then here you have even a retest. And that is why I said in the beginning that retests are a very common feature in today's markets, and that you need to take this into consideration when you place your stop loss. So many traders place their stop loss always too close. They really suffocate their trades, and they often miss out. So they get into a trade, they see the market is moving a little bit in their favor, and as soon as that happens, they pull their stop loss to break even, and then the retest comes, they're taking out, and the price goes to their target, but without them, because they have suffocated their trades. And you need to plan for retests, because retests are very, very common. So I would really recommend that you start paying attention to retests and see that they are quite common, and then you can implement that in your trading plan. And you can see after the retest, this is what happens. The market started a huge uptrend, and it all started here with this transition. So when a market goes from one trending phase into a transition where the trend is not continued, you shouldn't automatically just go long because the market is going sideways, but this should be your first really big heads up. And then you start to try to create trading plans that could help you find a new trend. I really love trend lines. I've been trading trend lines for probably around 10 years. And trend lines can be really great tools for swing traders. And whenever I see a great trend line, this is where I get very excited. It doesn't mean that I automatically get into a trade, but it is a starting point for my analysis. So here you can see the market giving us this nice downward trend line. We can really nicely describe the trend here. And you can also see that the market pre-breakout is giving us this nice pattern. What is this pattern? You can see when you put an RSI in here, you get a divergence. And then here, when we look here at the right side, here would have been then a head and shoulders, or an inverse head and shoulders. The left shoulder, the head, the right shoulder, and then a strong breakout. So a trend line shift with a lot of context can be a great signal, can be really, really a great tool to get into a trade. And of course, you don't have to trade a breakout. Maybe you just use that as information and then you wait for the market to get back here. You wait for the market to come back and retest this area if you want to become a pullback trader. And this is how it looked afterwards. You can see this is where we had the trend line. This is our inverse head and shoulder. This would have been a potential entry on the breakout. But you can see the breakout would have really hit the moving average. And those can be sometimes a little bit trickier to trade. What is often a much better idea is to wait for one more layer of confluence. And we get that confluence here. So what is the market doing now? This is really, really an important piece, because now the market is retesting the previous highs. The previous highs are becoming now support. So resistance is turning into support. And now the market is also rejecting the moving average. And this is so critically important. When you see that the market on the breakout after a really, really important change of market structure is also rejecting the moving average, this is really where new trends often are created. And how do you trade that? Obviously, you have a few options. You could then trade it right at the retest. You could even have traded it on the breakout. And then you could again use Fibonacci extensions for targets. So 161 is usually where trend following traders go for. You could also have obviously an approach where you scale out of your position. So you could have maybe a first target at 161 and then let the rest of the position run to 200, trail your stop loss along the way. And this is how it could or it would have looked afterwards. You could have then chosen to use the 50-period moving average as a way to trail your stop loss. That is how you can very nicely use the stop loss as well. And you can see the market hit 161, hit 200, and then pretty much after that, the trend has died down. So a great way how you can use multiple tools to find a great trading opportunity. We have also continuation patterns, so we don't only have reversal patterns, we don't only have patterns like the momentum death, but we also have continuation patterns. And flags are probably the number one trend continuation pattern there is in the markets. When we talk about classical and conventional patterns, flags are just so powerful. And what we have here is a downtrend, and if you have missed the downtrend, or maybe you're in the downtrend and you want to look for ways how to scale into a position, you could use then a flag. So the market will never move in just one straight line to your target, but there's always this back and forth, and you can use the back and forth to really for your advantage.